On a single Tuesday last month, the Federal Reserve's own data confirmed a quiet, terrified shift that the mainstream media completely missed. While you were distracted by the election cycle, while you were watching the stock market hit all-time highs, and while the politicians were telling you that the economy is stronger than ever, something sinister was happening in the plumbing of the financial system. I want you to listen to this number very carefully. $6.4 trillion. That is the amount of money that has officially fled the U.S. commercial banking system. It didn't just vanish. It didn't just get spent. It moved. It parked itself in government-backed shadow accounts that effectively bypassed the banking system entirely. I've spent the last 48 hours combing through the Treasury's quarterly refunding announcement. I've been digging through the FDIC's balance sheet data. I've read the fine print of the Federal Reserve's H.4.1 release. And what I found isn't a recession prediction. It isn't a theory. It is a mathematical certainty. The liquidity that keeps your local bank branch open is drying up. The cash that funds your mortgage is disappearing. The capital that runs small businesses is evaporating. And it's not an accident. It is a structural run on the system that is happening in slow motion right in front of our eyes. This is finance evidence. We track the capital flows the media ignores. We follow the smart money when it runs for the exits. If you want the truth about your money, and if you want to know why the banking system feels so fragile despite the politicians telling you it's sound and resilient, you are in the right place. Today, we are going to expose the three-part trap that has been set for your savings. We are going to look at this silent run that is draining the banks. We are going to look at the legal trap that Congress set to confiscate your deposits. And we are going to look at the digital endgame they have planned for the survivors. Let's start with the signal that nobody is talking about. I want you to look around your city. Really look. What do you see? You see bank branches closing. This branch is permanently closed. ATM out of service. You see it in the cities. You see it in the suburbs. They tell you it's because of digital banking. They tell you it's for efficiency or modernization. That is a lie. You do not close the doors of a business that is flush with cash. You do not shut down locations when you are drowning in profits. You close the doors when you are trying to stop the bleeding. You close the doors when you are trying to cut costs because your primary source of funding is walking out the door. According to the Investment Company Institute, or ICI, the total assets sitting in money market funds have just smashed through the $6.1 trillion mark. Now, $6 trillion is a number so big it's hard to wrap your head around. It sounds like monopoly money. So let me put it in perspective for you. That is roughly 25% of the entire GDP of the United States. It is more than the entire federal budget for a year. It is enough money to buy Apple, Microsoft, and Google combined, and still have trillions left over. And you have to ask yourself, where did that money come from? It didn't fall from the sky. It came from bank deposits. If you look at the charts, bank deposits have dropped by nearly $1 trillion since their peak. This is what we call the silent run. You know what a bank run looks like in the movies, right? It's people panicking. It's lines around the block. It's people banging on the glass doors in the rain, screaming to get their cash. That is a loud bank run. That makes the evening news. That forces the president to get on TV. But what is happening right now is a silent run. It isn't happening on the street. It's happening with a mouse click. It's happening on mobile apps. It's happening in corporate treasury departments and skyscrapers in New York and London. Think of the banking system like a restaurant. The bank is the restaurant. The cash, your deposits, is the food in the pantry. For 50 years, the pantry was full. The trucks came every day. But suddenly, the delivery trucks stopped coming. The chef is looking at the shelves, and they are getting bare. But the restaurant is still open. The lights are on. The music is playing. The host is still seating people at tables with a smile. But if everyone orders the steak at the same time, the kitchen is going to collapse. The waitress in Ohio, the small business owner in Texas, the retiree in Florida, they are sitting at the tables. They assume the food is there because the sign says open. But the smart money, the hedge funds, the corporations, the billionaires, they already peeked in the kitchen. They saw the empty shelves. And they left the restaurant an hour ago. This isn't money sitting on the sidelines, waiting to buy stocks. This is money that has effectively left the building. It has exited the commercial banking ledger and moved to the government ledger. And here is the terrifying part. The banks cannot get it back. They cannot compete for it. And the reason why leads directly to a law Congress passed quietly and a fiscal disaster that is spiraling out of control. You need to understand that Congress didn't just spend too much money. We all know the debt is high. We all know 35 trillion is a bad number. But what you might not realize is that they have weaponized the interest rate against your local bank. Let's look at the Congressional Budget Office, the CBO. They released their baseline projections recently. They project interest costs on the national debt hitting $1.6 trillion by 2034. But honestly, they are being optimistic. They are dreaming. We are already paying over $1 trillion a year right now, just to service the debt. That's more than we spend on the military. That's more than we spend on Medicaid. To pay for this massive mountain of interest, the U.S. Treasury has to issue more debt. They are issuing $1 trillion in new debt every 100 days. Think about that. Every 3 months, the U.S. government sucks another $1 trillion out of the global economy just to keep the lights on. To get people to buy that much debt, they have to offer a high interest rate. They have to bribe you to lend them money. If they offered 0%, nobody would buy it. So they have to offer 5%. Right now, the government is paying roughly 5.4% on short-term treasury bills. And this is where the trap snaps shut on the banks. The government is now your bank's biggest competitor. The U.S. Treasury is standing there saying, "Lend me your money, and I'll pay you 5.4%, risk-free. I have a money printer. I cannot default." Your bank is standing there saying, "Please keep your money in our savings account. We'll pay you 0.01%. And by the way, we might go bankrupt." It is a forced liquidation of the banking sector. Why would any rational person or any rational corporate treasurer leave millions of dollars in a bank earning nothing when they can move it to a money market fund that holds government debt and earn 5%? They wouldn't. And they aren't. That is why $6 trillion fled. Now, I know what you're thinking. You're asking the obvious question: why don't the banks just raise their rates? If the government pays 5%, why doesn't Wells Fargo or Chase just pay 5% to keep the customers? They have record profits, right? I have the proof why they can't. And it's not because they are greedy, though they are. It's because they are insolvent. If a bank pays you 5% on your deposit, they go bankrupt immediately. It's simple math that they are desperately trying to hide from you. You see, banks don't just keep your money in a vault. We have this cartoon idea of a bank where Scrooge McDuck swims in gold coins. That's not how it works. When you give them your money, they lend it out. They buy assets. And back in 2020 and 2021, when interest rates were at zero, banks took your money and they bought trillions of dollars worth of mortgages and long-term bonds. But here's the problem. Those bonds paid 2% or 3%. This is the yield trap. They are holding assets that pay them 3%. If they have to pay you 5% to keep your deposit, they are losing 2% on every dollar every single day. They are bleeding cash. So they have a choice. A deadly choice. Option A. They keep their rates low, 0%. The result? The depositors leave. They lose the liquidity. That's the silent run. Option B. They raise their rates to 5% to keep you. The result? They pay out more than they bring in. They run out of cash. They go bankrupt. They are trapped. They have chosen option A. They are hoping they can shrink gracefully. They are hoping you won't notice that they are offering you a terrible deal. But the hole in their balance sheet is too big to ignore. While the Federal Reserve Chairman Jerome Powell goes on 60 Minutes and says the U.S. is on an unsustainable fiscal path, and while Janet Yellen tells you the banking system is sound, the balance sheets tell a different story. They scream insolvency. According to the FDIC's own quarterly banking profile, U.S. banks are sitting on $517 billion in unrealized losses on investment securities. Half a trillion dollars gone. What is an unrealized loss? It's a fancy accounting trick. It means the asset has lost value, but as long as they don't sell it, they don't have to admit they lost the money. It's like if you bought a house for $1 million and now it's worth $500,000. You can tell your friends, "I have $1 million house." But if you have to sell it tomorrow to pay a debt, you don't have $1 million. You have a $500,000 loss. That works fine for a homeowner who doesn't have to sell. It does not work for a bank. Because if you go to the bank to withdraw your money, they have to sell the asset to pay you. And the moment they sell, that unrealized loss becomes a realized loss. The capital evaporates. The bank becomes insolvent. We saw this with Silicon Valley Bank. They had to sell bonds to pay depositors. They realized the losses. They died in 48 hours. Smart money knows this. That is why they are skipping the bank entirely. They are buying treasury bills directly. They are essentially saying, I don't want the risk of the bank. I want the asset the bank owns, but I want to own it myself. You don't have to be a victim of their insolvency. You can own the same assets they own without their risk, but you have to move before the crisis hits. And believe me, the crisis is coming from more than just government bonds. There is a time bomb ticking in the commercial real estate market that makes 2008 look like a dress rehearsal. The assets backing your deposits are collapsing in real time. A recent paper from the National Bureau of Economic Research, the NBER, titled Monetary Tightening and U.S. Bank Fragility, found that 14% of all bank loans are in underwater commercial real estate. We have all seen the headlines. An office tower in San Francisco that sold for $300 million a few years ago just sold for $60 million. That is an 80% haircut. That is a wipeout. Who took that loss? The bank that lent the money. But here's the twist. The big banks, JP Morgan, Bank of America, they have some exposure, but they are diversified. They have credit card businesses, they have trading desks. They can absorb a hit. The ones who are holding the bag are the small and regional banks. The banks where you probably have your checking account. The banks that sponsor the local Little League team. Small regional banks hold 70% of all commercial real estate debt in America. They lent money to build office parks that are now empty because everyone is working from home. They lent money for strip malls where the tenants are going bankrupt because of inflation. And billions of dollars of these loans are coming due this year. It's called the maturity wall. Commercial loans aren't like your home mortgage. You don't lock in a rate for 30 years. They usually last for 5 years, and then you have to refinance. Imagine you bought a building 5 years ago. You were paying 3% interest. The building was full. Life was good. Now, the loan is due. You have to refinance. But the bank wants 8% interest. And your building is half empty. You can't pay. You walk away. You mail the keys to the bank. Now the bank owns an empty building. They don't want a building. They want their money. But the money is gone. When these loans default in 2025, the $6 trillion run we talked about earlier is going to accelerate into a sprint. The depositors at these regional banks are going to realize their bank is holding a portfolio of empty buildings and worthless bonds. They are going to panic. And this time, when the banks fail, there will be no bailout. I need you to listen to me very carefully right now. The rules have changed. The game you think you are playing doesn't exist anymore. In 2008, they did a bailout. They used taxpayer money to save the banks. It was politically unpopular. Congress hated it. The public hated it. It gave birth to the Tea Party and Occupy Wall Street. So they passed a law to make sure it never happens again. It's called the Dodd-Frank Act, specifically Title II, and it introduced a new mechanism called the bail-in. Have you ever read the terms and conditions of your bank account? I know you haven't. Nobody has. It's 50 pages of fine print. But if you did, you would find a terrifying legal definition of who you are. You think you are a depositor. You think you are a customer. But legally, you are an unsecured creditor. When you deposit money in a bank, legally, you are not storing your money. You are lending your money to the bank. You are loaning it to them. If that corporation goes bankrupt, you stand in line with everyone else asking for your money back. You are behind the secured creditors. You are behind the derivatives counterparties. You are at the back of the line. The FDIC has released documents detailing their resolution strategy for the next crisis. It's called the single point of entry strategy. In a bail-in scenario, when a bank fails, the regulators step in. But instead of the government writing a check to fill the hole, they look at the liabilities of the bank. That includes your deposits. They have the legal authority to take a portion of the unsecured debt, that's your money, and convert it into equity. They will turn your cash savings into stock in the failed bank. Imagine waking up one morning to find your savings account is empty. But congratulations, you are now a shareholder in a bank that just went bankrupt. You own stock that is effectively worthless. They call this recapitalization. I call it theft. Former FDIC chairs have warned about the limits of the insurance fund. The FDIC insurance fund has about $120 billion in it. There are trillions of dollars in deposits. Do the math. 100 billion covers maybe 1 or 2 mid-sized banks. If a massive contagion hits, if 100 regional banks go down at once, the insurance fund is wiped out instantly. The bail-in is not a conspiracy theory. It is the law of the land. It is the written strategy. Why are they letting this happen? Why are they letting the regional banks bleed out? Why are they letting the commercial real estate market collapse without intervening? It seems intentional, doesn't it? It feels like a controlled demolition. Because out of the ashes of the banking system, they plan to launch a new system. The chaos is manufactured to manufacture consent for the solution, central bank digital currency. They call it Project Cedar. The New York Fed has already completed phase 2. They are testing the plumbing right now. When the crisis hits, they will say, commercial banks are too risky. Open an account directly with the federal. It's safe. It's digital. But you have a choice. You can leave before the doors close. The $6 trillion run has started. The smart money has already left the building. So, here's my question to you. We are standing at the edge of the greatest liquidity crunch in history. Do you trust the FDIC to print enough money to save you? Or are you becoming your own central bank? I want to know where this community stands. Scroll down to the comments right now. Type FDIC if you think the government will save you. Or type self-custody if you are taking control of your own assets. I want to see the ratio. I want to see if we are awake. This is finance evidence. The warning has been issued. The evidence is on the screen. The rest is up to you. Make sure you are subscribed because the situation is moving fast and you cannot afford to miss the next update. I'll see you in the comments.